Well, greetings and welcome to another edition of the Deal Flow Show. I'm JP Maroney, your host, along with my co-host, Mr. Paul Nicolini from here at Harbor City Capital. And we've got Jay Soave on the show with Cadence Capital. And want to jump into real quick, and I've done a little bit of research, talked to you in advance through our team, and want to learn a little bit about how you got started in the capital markets. And then we're going to kind of dig inside your knowledge of how you put deals together, your process for vetting things, and what the deal breakers are, what the deal makers are for you. So Jay, let's go back a little bit and talk about how you first got started in the capital markets.
Yeah, so I took a little bit of a unique route. So again, thanks for having me too. Enjoyed being here. So I was an attorney for 17 years and had always had an eye on doing something different. And my goal was to get into something in the private equity and the VC side of things. Always been a deal junkie my whole career. And in 2009, I got a job in New York City at Tishman Speyer, a pretty large real estate private equity fund, and working on all sorts of transactions. They had done a lot of fund work, but really started moving in the one-off joint venture type developments and acquisition platform. And so basically that's what I do now. And through the course of that, I was always looking for an opportunity to try to do something more on the business side. And when my partner and very long time friend, Michael Bennett, started to think about starting an equity arm for Cadence, we continued to talk. I mean, we had been talking for years anyway, and it was the right time. And so jumped ship in the beginning of 2018 to join him in building the platform further. And it's been a fun ride.
So when you make a big shift like that, after having been on a career path the way you were, what were some of the biggest ahas or things that you didn't expect coming in?
Well, I think some of the biggest things is just I will be frank, it was a lot of fear, frankly. I hadn't done this before. I went from a position where I was passive. Things came to me and I dealt with them. And certainly working in-house was better than, in my view, at a law firm. At least then I had more control. I saw things from beginning to end. It was kind of my show to run things, but still wasn't really called on to kind of go out there and make it for myself. And so, leading up to the time when it actually happened, I was a little bit petrified. But I think when I first started, I was probably terrible. And but over time, what you just learn is that you put in the work, you put in the time, you make the calls, and you get better and you get better. And at the end of the day, ends up you look back and it's like, this isn't scary at all. This isn't a problem at all. And I'm very glad that I did make the move. Got a great boss.
Is there a specific area of the real estate that y'all gravitate towards? And then how have you seen that affected by this post-COVID situation?
Yeah, so we are asset class agnostic. That being said, and we'll do acquisition deals and development deals, but generally where we're seeing most of our work is on the development side. And today it's probably primarily multifamily, and multifamily is the biggest asset class anyway. So those are probably where we spend the most time, both pre and post COVID. We also do opportunity zone work too, but it's not exclusive. It really was, I left it out. I was a tax attorney for those 17 years and in-house. And so kind of when this came about, I just saw that it was a very, very powerful program and we should get involved there. And it kind of really played into our strengths of our database and how we run our process. We can talk about that later. So we do that too. COVID has affected a lot. And it really hasn't changed our focus all too much other than continuing to be selective in our process. We have a screening tool that we put together with the MBA students from the University of Michigan. They have like an outernship program that they're all required to take that helps us to look at the factors that capital finds important. So we connected them with some family offices and investors and developers, gave them a crash course, and then sent a survey out to our sponsors to help us weed these deals out because we work on a contingency basis, and I don't want to work on things I'm not going to get paid on. So, but that also helps us to make sure that we're taking on deals and we're beating up deals before we take them out. We don't find the landmines 3 months into it, 4 months into it. And I think what's happened today in the post-COVID world is that there are groups who are, kind of sitting out, waiting to see what happens because they think maybe there's going to be more trouble coming. You haven't seen a lot of it yet. And that might just be a factor of there's been a lot of government intervention, like, well, you can't kick people out, you can't do this. And we'll see what happens with that. And there's certainly been a lot of fiscal stimulus to date. What happens if 3 or 4 months from now and that doesn't take place? I'm assuming that will take place, but regardless of what happens. And so it just caused a big upheaval. And so people are just they're either sitting on the sidelines waiting for the other shoe to drop. Coincidentally, that's what happened in April. They're like, oh, well, it's fine in April, but May's going to be worse, and it never did. And well, May's fine, maybe June's going to be worse, and never did. So it's been pretty resilient to some extent, but people are much more cautious. And there's definitely a preference for existing product compared to development product. There's certainly multifamily and industrial are more preferred. I mean, hotel and retail are kind of a mess right now. Retail was already a mess. It's just more mess. And office is the big unknown. And because it's a big unknown and how it's going to play out, it also is not getting a whole lot of traction. And so at the end of the day, we're just concentrating on the things that we think people are going to be interested in. And that's multifamily and industrial mostly. Some medical office as well.
You talked about office. Yeah, I saw the other day, I think it was California, an article I was reading about where they were dumping massive amounts of sublet office space into the market. Certainly, we've seen it. I mean, you're coming in virtually with us, whereas we would love to have you here on the set. A lot of people are figuring out that they can do business remotely, where it was an option before it became a mandate. And now I think many people will never go back to the way things were before. Incidentally, if you're watching or listening to this episode of the Deal Flow Show, you can get access to our archives, our previous episodes, as well as our future episodes, and subscribe and follow us by going to thedealflowshow.com, thedealflowshow.com.
Jay, we've heard from many of the past guests about the Jobs Act, so we know that that's also impacted Cadence Capital, and maybe specifically in the opportunity zones. You want to talk about that?
Sure. So, as I have a little bit of a deep inside knowledge. I mean, real estate has always been a very generous tax investment for investors. There's a number of provisions that you can defer recognizing income using depreciation and other methodologies. So has great advantages. You could do tax planning for generational transfers. There's a lot of things there that are, very, very detailed, but they're there. And when you add the opportunity zones onto it, but basically where you can invest capital gains of any sort into a project, defer paying taxes on those for a number of years, and then if you hold that asset for 10 years, you don't pay tax when you sell it. That's pretty powerful. And all the other stuff that already applied to real estate still applies too. So that you don't lose out on those other benefits at the same time. And so I think it's continuing to be and will continue to be something that people are interested in. I think what's happened to some extent was there was this idea in some people's minds that, opportunity zone, I can charge, or people will pay more for something. And so my returns don't have to be as strong from a sponsor perspective. And that has not played out to date. People are very cautious. They want to make sure that the real estate is a good, strong deal on its own, regardless, because tax benefits don't matter if you have a loss. So they're very concentrated on it, and people really are starting to gravitate more and more to it. It just it's complicated, and it's not for everyone. It's not for just jumping off the shelf and saying you're going to learn about it, because as with anything in tax, unfortunately, it gets very complicated very fast.
What are the bookends in terms of size of deals, smallest to the largest, and then kind of what is y'all's sweet spot?
Sure. We usually don't go below 10. We've done certainly a couple 7s or 8s on the equity side of things. And then on the larger side, I like big deals. I'm used to big deals. So we're working on a couple $100 million projects. I think we prefer typically to be in the 15 to say $30 million range. I think that's primarily because that's where the bulk of our capital resides. I mean, we have family offices, private equity funds, big, small, large, banks, insurance companies, et cetera. And it just kind of that range overlaps a lot of those groups. And so, again, from our standpoint, we want to take on deals that we think are going to have a high likelihood of being financed. And so I like to play in the space where there's the most, arrows to shoot.
So y'all are raising the equity for the projects?
Yeah, we raise equity, we place debt. I don't want to say that we don't do that. I mean, that's my concentration on the equity side, but we have a whole debt team as well. Can do mezz, construction, bridge, whatever it might be. But on the equity side, which was my specialty and the bulk of what my firm does, we're looking to find that single bullet investor to take 90% typically of the common equity in the deal.
And are you selling it based on the tax strategies? I mean, does that come into play in your deal making process, that background that you have?
No. On occasion I do, and maybe I did more when I was first getting going, but I don't even bring it up really at all.
So Jay, let us understand though, you look for single check writers, is that what you said?
Yes, sir.
On the capital stack, when you're looking at, let's take a $50 million deal, how much of that is going to be equity?
Typically 35%, 40% these days. It was starting to creep up where you could get more pre-COVID. One of the things that's happened is that pretty much overnight, the banks themselves have really cut back on lending. I think they're lending to their relationships. So, like a Bank of America type bank and the local banks. And then on the, I think some of the debt funds got hammered. And so leverage has come back down and people are being very conservative in what they're lending on. It's getting better. I mean, May compared to today is night and day, but it's still not anywhere near what it was 9 months ago, whatever it was.
You played, with your background, sorry to talk
That's
about
all right.
that. You played a different role, as you said, with your legal background in the beginning days before making this shift. But, today, I guess, but I would be willing to bet that you take a different approach to vetting deals than the average bear because of your legal background. But when you're looking at deals and vetting deals, that pre-deal making process, can you walk us through how you think, the mindset, the process, maybe some of the steps?
Yeah. So I think the first thing we want to do is we're going to take a look at, we like to get dirty so if there's something that's put together that's great as far as like an offer and memorandum, we usually create our own, got our own ideas on how that should be done. And what we're getting the Excel underwriting, and we're going to go through that and we're going to beat it up. We want to make sure that investors expect to see things in a certain format and that things are done on like a monthly basis as opposed to an annual basis. When you have like a 3-year deal, if you do something annually, you get a much different answer when you do it over what might be 40 months. Anyway, so put it into a format that makes sense. And then we're going to, I'll use multifamily. Every deal's got their own kind of metrics. But multifamily, so what are the rents? How do those compare to market rents? How fast are you leasing this up? Are you increasing rents during the construction period? How much? Where are you seeing exit cap rates? And how does your exit cap rate compare? And then lastly, one of the big things that people focus on is the delta between your exit cap rate and your yield on cost. So what's that spread? And 1.5% is a good rule of thumb. It's a little bit tighter in major markets. It's wider in not so major markets.
Jay, to that point too, there's a lot of moving parts when the deals are being made. What are some of the red flags, or what are some of the deal breakers for you and for Cadence?
Well, I think sponsorship is important. I mean, it's always been important, and now I think it's even more important. I think that this is something that's pretty subjective, but you kind of get a feel for things, or if there's some kind of game playing going on, or something that usually starts to not sit very well. From us, I think there usually should be a story. There should be a good geography, I think, is one of our first things. If it's going to be outside of a certain geography, you're probably not even going to look at it. And then the returns, we just have a certain return expectation in our mind of where we think things should be today. And if it doesn't hit those initial benchmarks on our first pass, it's probably, it's out. And then where there could be landmines after that, everywhere. Just gotta be deal specific.
Anything else about the opportunity zones that you can share? I know that's been a big topic. There's entire conferences and events around it right now. Where you see that going over the next few years?
I think it's going to continue to grow, because it's really maybe it's in the second inning now, where at first people didn't understand it, that it's a whole brand new branch of the tax law, frankly. And when you typical tax stuff, not to get too nerdy about it, but they develop over 10, 20, 30, 40 years. I mean, my whole job was full-time to figure out how to deal with tax rules that have been in existence forever. And so that's the amount of complexity. And we continually find, in every person in that field finds gray area all the time. So you can imagine when you have a whole new set of everything with all these new rules and details that, again, it falls off very quickly. I mean, high level, it's very easy, but devil's in the details. That's very hard to get your arms around and get comfortable with things, especially when you're talking about potentially get a single check writer for $40 million. The tax consequences could be significant, bigger, even more. So people were very cautious because they didn't know how these things were going to play out. And then over the course of 2019, more and more stuff came out, got people more comfortable. And now you're starting to see that put into practice. We're like, okay, we have a lot of the things taken care of. We have a lot of the questions solved. Now let's go find deals that make sense. And I think that the market is maturing to the point where there are less of these deals out there, I think, or I haven't seen as many lately, that are just pie in the sky type things. I don't want to list any of them because it might be obvious, but some of the things I've seen were just insane. They just were insane. And I just didn't understand sometimes, like, who thought they were a good idea and how they convinced themselves to spend time doing it. But they continued to happen. And what that happened to do too was to turn a lot of people off from the investment side, because if you're sitting there, you're at a family office and you've got a lot of money to manage, and every time you get an opportunity zone deal, it's some crazy project that doesn't have any basis to reality, or the return expectations are just not realistic for someone who wants to make money, you just kind of like get jaded to it. And I think that as that has died off and people have maybe done a deal, know someone who's done a deal, you're going to continue to say, okay, this is a good program. There are good opportunities out there. I should be looking at this. And it's just going to continue to grow.
Other than the obvious simplicity maybe of having a single check writer, why did Cadence decide to go down that path? In other words, why is that your choice for raising the equity?
I think it's the simplicity and really, I mean, it's my comfort zone, and it's really where I think we spend a lot of time finding and harvesting investors. And we're looking to find people who are sophisticated, who can interface with the sponsorship group. We can do a lot of them because our database is very diverse and large. I think if you were to go down the path of finding $100,000 check writers, you got to amass a pretty substantial database of those. It will take a very large amount of time. And I think at some point, unless you get to a really substantial number, it's going to impact the number of deals that you can do, because obviously, even though you have a very large database, there's only so many deals that certain people will do. And obviously the check size might be bigger or smaller. And so your capacity will be constrained. And putting that all together, I think that's really the primary reason.
How have you, and this may be secret sauce, I don't know, but how have y'all built that database? It's one thing to compile a list of potential targets. It's another thing to have a relationship with them to get in the door, as well as to persuade them that it makes sense for y'all to be a part of the project. So what's been y'all's process for building that network and that database?
So I think the secret sauce is hard work. And you're right. I have two jobs. My one job is to find clients and execute on the deals for them. But my other job is to find other capital sources too. And so it's a background process that's happening both in connection with the deal and just passively, and identifying people who we want to target. And so that could be from connections with other capital sources we have, reading articles, and you're like, oh, who's that group? I've never heard of them before. And just general digging around, you learn more and you find out other groups, and then you do the hard work, which is trying to get a hold of them. I mean, a lot of our time we spend, particularly on the family office side, it's a hard cabal to kind of break into, but you spend the time because it's worth the energy. And as you do that, as you do more deals with those types of groups, the more they're open to conversations with you and introductions to you. And so it's just part of the grind. And it's a good way to get those minor victories on a week-to-week basis, where you get there and group you've been trying to get in front of for 6 to 9 months, and then they're finally like, all right, let's talk. And part of it, and then obviously maintaining those relationships. But what we try to do specifically is we want to make sure we understand what everyone wants. It's not that I just know that this group is out there and they have money. I want to know, what do you want? Where do you want it? What's your risk profile? What's your check size range? What asset classes are you interested in? So that when there's an opportunity, I send them something that they want. Not so that what we're trying to avoid is sending them a whole bunch of things they don't want, so that when my email comes in, they just delete it. I think some of our competitors have a different tactic, and they just blast. And I don't want a Hobby Lobby in Tulsa. So maybe those are good deals, but you just kind of get to the point where you're getting these emails that you might not want, and you just get numb to it. So everything is really done to preserving and maintaining those relationships with capital. Send them deals that they want. Send them deals that we've vetted. Send them offering memorandums that are direct, straight to the point. Here are all the things that you need to know whether you want to talk about this further on page 2. Not at the end of this thing after cruising through 50 pages. Oh, there's a tenant can kick out in 2 years. It's like, that's the whole thing. So all of it is done with a view to making sure that they're happy and continue to just answer our emails.
Jay, outside of the opportunity zones, give us a 30,000-foot view of where you see the real estate market going, and then where does Cadence Capital fit into that scenario?
Sure. I think the easy part we fit in is that when things get hard, we're a good group to know. We have a lot of relationships on the capital side with people who have money and are looking for opportunities. And it's always about, and it really helps to know what you want. I mean, we spent a month, 2 months in April and May talking to probably 400, 500, 600 different capital groups to understand, and banks and lenders. What do you want? What are you doing right now? So that's how we reacted to it. And so now when I have things that might be a little bit outside the box, or a distressed opportunity, I know some of the groups that want those. And so I'm just going to send it right to them. And maybe, that's how we get really good at our job, when we see opportunities where It's like, I know who wants that. That's this group. And you could be very efficient with your job. And then, as what's going on in the world, I think you're going to continue to see industrial being gangbuster. It's just, it was before COVID happened. It's even more so now. I knew a group that was under contract on 5 or 6 deals in a portfolio pre-COVID, dropped it in COVID, bought it 10% higher pricing after COVID kind of hit. So it's on fire. You're going to continue to see, I think multifamily will continue to do well. And I think people are going to make some good bets on the office side and the retail side and the hospitality side, because it's not all going to fail. And I personally believe that office is going to come back or maintain or whatever it is to some extent. You're going to have, maybe people want more space. There was a group that was just signed a lease in Chicago, and one of the biggest things that they wanted, they tripled their size, I believe. And one of the reasons why they tripled their size was because they wanted more space for the people. And maybe that becomes a theme where it offsets some of these people working from home. But I also believe too that the office doesn't go away because of the collaboration element. And maybe it isn't necessary for every job role, but when I certainly did transactions and when I was an attorney, I can't count how many times I would just quickly go down the hallway to get an answer on a question, or sit in my boss's office for 3 hours pounding through something that's very complicated, trying to get to the bottom of it, where that is best done internally and then in a collaborative environment together. Or another way where you just go down the hall, you go talk to your buddy and you say, oh, I'm working on this deal and I got this thing. He's like, oh, well, you should call this guy. Or did you think about this? And takes that thing in a whole new direction. And I'm talking about transactions, but I think that's one of the reasons that you're going to continue to see that in the tech world. Facebook has been doubling down. They basically said this during the Great Recession. They were like, well, what we're going to do is we're just going to get more space at a cheaper price. And you're seeing them do the exact same thing today. They're just going to gobble more and more of that space because that's what they see. And if Facebook is doing that, everyone's going to be doing that. What I also find is that it's hard to train people. And how are you, if you're a small business, maybe 4 or 5 people, sure. If you've got, like Google hires 20,000, 30,000 people a year, how do you train those people if they're all over the place? And then lastly, I think from a productivity perspective, I was a young guy once. I know Paul personally, he's a man who likes to have a good time. And, did you want to have a 21-year-old Paul and just said, here, here's 80 grand, check your monitor. I don't think that's really a very productive use of people's time. And so the small cost of real estate compared to having to train and bring in new people or finding people that work efficiently, just doesn't justify the work from home experience. And so I'm just a believer that it's going to continue to, it's going to come back or stay or whatever you want to call it. Maybe with some tweaks here and there.
Did I hear him right? Was he throwing me under the bus?
I don't know. I was looking at you. Do you look like a guy that's partied too much?
It's a compliment. If anyone
Actually, we did have a good time up in Napa.
And have some drinks with a good man. Paul's the man.
Jay, tell us though, how not everything goes up and not everything goes your way. How does Cadence deal, and maybe yourself as well? How do you guys deal with failure?
It's inevitable. I mean, I think that's a good thing to ask. I mean, when I was first starting, that was another thing that was, I think, hard for me too, with getting into this type of business. Is you try not to get too emotionally invested to say it, or maybe another way, you don't spend the checks before they're cashed kind of thing. And, because you just don't have control. At the end of the day, I don't have control over any of the decisions that the capital groups I introduce to deals, what they're going to do. And you could show a deal to 50 different people. They have 50 different reasons why they don't like it. And so the hardest thing to do is just to kind of like take a very boring, just stable approach to everything and just know that, you're doing everything that you can. And once I've done everything I can, I start going to look for other deals to work on, things to work on to occupy my time. So I'm not sitting there just, lamenting about it. And then if that inevitable disappointment happens, or this thing that, comes out of left field happens, you kind of look and you're like, that's the most ridiculous thing I've ever heard. I can't even understand this. Then because I haven't gotten invested in it, you get over it. Maybe 2 years ago, 3 years ago, that would have been like, a couple of days I needed to recover. Now it's just like, this is absurd. And, long. Just, you get thick skin.
Fair enough. When you think about failures, or what I call learning experiences, learning opportunities, you're looking in the past. I want to look into the future in just a moment. But if you're watching or listening to this episode of the Deal Flow Show, you can get access to our archives, all of our previous episodes, as well as get access to our future episodes by subscribing and following us at thedealflowshow.com. Thedealflowshow.com. All right, Jay, so here's the question. For yourself personally, it could, and I'm going to open it up just a little bit. It could be professionally or personally. Are there any unmet or unattained as yet goals, things that you're still reaching for that get you up and get you excited in the morning?
Oh yeah, for sure. I mean, I think it's, I enjoy the hunt. I enjoy the chase. So that's always there. But I think it's to continue to grow. I do look back from where we were to where we are today. And I am very happy and very impressed. We've come a long way in a short period of time. We've come to be an effective source for doing something that's very difficult on the equity side of things. And I'm very proud of our people for what they've done. And I think that the sky is the limit for growing that team further and growing on our platform further. And we want to. We're in hiring mode. We're looking for future investment sales people. We're talking to a few there. We're talking to additional debt people. We could always use more leverage there, and selectively on the equity side too. And then finding creative ways to continue to find more of these great relationships that we have. Always some other goal, but growth is our goal. Speaking
of hiring more people or bringing more people on the team, it could be that, or it could be other resources here at the Deal Flow Show, and then our own networks professionally. Obviously, we know a lot of people. We've built a big network. What are the kind of people that you would love to hear from as a result of seeing or hearing you on the show, project-wise or potential team members? What are the kind of people that you would like to hear from?
I like good people, first and foremost. I think that makes everything more enjoyable, to be honest with you. Time is short. I don't really want to, I didn't do this and come and do this thing just to make money. I don't want to work with a-holes, and life's too short for that kind of thing. So good people on the client side, and certainly that is probably a gating issue on our side. We have 15, 16 people total. Everyone gets along. Everyone has a fun relationship with each other. We have annual retreats where we go out. We would usually go to Denver, go out the mountains or whatever, and hang out. Everyone has a good time. It's just like this, got some terminology that I use. Maybe it's not appropriate for here, but it's like a no jerks policy, and that's pretty solid. And then from there, it just depends on the role, but we're looking for people who have experience in the real estate world, and they're hustlers, because this is not a business for you waiting for things to happen. You got to get out there and grind it, and that's not for everyone.
There's a rule or a quote I use a lot of times. It's the law of emotional gravity. The law of emotional gravity states that one negative person can pull down 5 positive people, but 5 positive people can't pull one negative person up. And don't hire them to begin with if you can, and if you get them, get rid of them quickly, because they can destroy an organization, destroy morale, destroy your ability to do deals, ruin relationships with potential clients, or as you said, equity sources. And definitely get all the negative people out of your life and out of your company as quickly as you can. And I'm not looking your way for any particular reason.
I was just going to say I can attest because his partner Mike Bennett is a super guy, so I'm sure you guys got it going over there at Cadence Capital. Jay, tell us something that maybe the audience or our listeners, whatever, wouldn't know about yourself.
Otherwise, they wouldn't know. Well, I'm a big University of Michigan fan, so they might know that. Me and my partner and a few other guys own a house in Ann Arbor, 3 doors from the stadium. So I think that's a little bit. I mean, I'm a big Muay Thai guy. Did that for 10 years, so love to do that. No fights professionally, probably not going to happen at this point, but certainly enjoy that. Big adrenaline junkie.
Well, what is the best way for someone to reach out to you? Is it a website, LinkedIn? What's the best way for them to get into contact with you?
LinkedIn is great, and then our website is cadencerec.com, and my emails and phone number are up there. So please reach out. We'd love to hear from capital looking for deals, people looking for opportunities, looking for equity sources. I'm happy to help there, and debt sources as well too.
Excellent. Jay Soave, Cadence Capital Partners, glad to have you on the show. And on behalf of my partner here in crime, Mr. Paul Nicolini, I'm JP Maroney from Harbor City and the Deal Flow Show team. If you're watching or listening to this episode and you're thinking, you know what, I know the perfect guest for the show, hey, maybe that guest is you. Get in touch with us. Go to thedealflowshow.com. There should be a link there in the menu for you to apply as a guest or suggest a guest for us. And we'd love to hear from you. If you're listening or watching the show and you know other people in the deal-making process, the capital markets, the investment space, and you know they should hear about the show, share it. Share it on your social media. Get the word out there. And we'll see you again on another episode very soon of The Deal Flow Show. Take care.
Thanks, Jay.
For more episodes, visit thedealflowshow.com and subscribe.